In today's video, I am going to be breaking down different stocks that look absolutely amazing to invest in today. So let's get down and let's check this out. First stock is Brookfield Asset Management, BAM-A, which is a Toronto stock. It currently pays a very small dividend of 0.97%, so basically 1%. So you wouldn't necessarily be investing in this stock for the dividend, even though that 1% is okay and not that bad. It's a lot better than interest. The current average volume is 1.6 million shares traded every single day, and the PE ratio is not that bad at 22 versus other stocks in the same field. If we look at the 5-year chart, it's actually quite interesting. It did trade sideways for a period of time, and then it accelerated drastically before the virus. Throughout the virus, it did drop twice, very similar to the rest of the market. However, it was able to recover at the same trajectory as it was actually going in before the virus actually happened. However, since then, it has hit what seems to be a bottom and is currently trading within a range. We just have to make sure that it does not drop below that range right there, in which case it should continue to go up. As long as it breaks through this side, we should be looking pretty solid. The only issue is that double top that we see right here, which could give us the reason why this drop even happened, but there has been a lot of things happening in the entire world as well, so you can't always read charts like that either. They also just recently took over a company in Australia as well, so that's kind of interesting. And something that has also kind of caught my attention is the fact that they have missed 3 quarters in a row on their earnings, but their revenue has continued to go higher year over year, which is quite interesting to me. Another thing I like to look at is, do they increase dividends? And as we can see here, they generally increase dividends year over year. Next is TD. Now this is it's the same as pretty much every other Canadian bank in my opinion. You cannot go wrong investing in a Canadian bank. Currently the Canadian banks have had a little bit of a drop off recently, and of course recently yesterday they did not do too badly on the stock market either. However, as we can see, they didn't do all that bad. However, what we can really look at is the fact that the PE ratios have come back down a bit, which is kind of interesting to start investing with the Canadian banks, as long as the Canadian economy continues to do well. The PE ratio of TD is 11.75, which is not the cheapest, but also not the most expensive either. And they also have an average volume of 5.8 million shares traded per day at this time, with a 3.8% dividend. On an average year, you will see an increase in dividend as well higher than inflation. And also TD is now potentially could be one of the top banks or biggest banks in the United States if they get this recent purchase closed next year. This, I think, will bring them into being the 3rd or 4th largest bank in the United States, which is kind of interesting. As we can see, they've recently had some pricing issues. Just like every other Canadian bank, everyone thinks that the Canadian economy is going to go to trash. Who knows if that's true or not? We'll have to see. But they did pretty much trade within a range before the virus, very similar to the whole market during the virus, and just like pretty much everything, it has exploded to the upside. The only thing to really keep your eye on is this. And the long-term trading range, it's right near the bottom of it, which means that if it continues to go down, there could be some more of a downwards trend. However, if it bounces off this point, you could be looking at a stock that continues to go higher. They have had 4 beats, and most likely the one that's coming up soon could be a beat as well. There's more and more analysts coming out saying that, and we've also seen massive revenue and earnings growth in the past year. In fact, they have almost doubled, if not doubled, their earnings while not doubling their revenue. This is because they've laid off a lot of staff, and like I predicted, they can make more money with less staff, giving more jobs to the staff they already have and saving money. This is why recessions are generally good for bigger businesses, because then they can cut essentially the fat, what they can call it, and at that point they can make more money with less money going out. And of course that just means that there's higher earnings, which then means higher dividends for us investors. While that may sound evil and mean, that's just how it is. Now, as we can see, they did have a 10-cent raise on their dividend recently. They haven't had a raise of dividend for a while, mainly because of the pandemic and the government, basically the government not allowing them to increase the dividend. Next is Enbridge. There's a reason behind me having this stock in this list, but it does have a 5.9% dividend, and I love dividends. I've said this before in many other videos, but Enbridge is actually kind of an interesting company. Yes, they are a gas pipeline and oil pipeline company, but they are investing into the future. They have solar as well as wind farms, and they're going into power distribution as well. So that is obviously the future. There's going to be more and more electric cars, etc. And because of that, of course, if you're currently in a fossil fuel style business, you probably want to start transitioning over to renewable energy, because energy is energy, and that is supposedly the future. I have my own thoughts on it. I think gasoline cars are going to be around for another 100 plus years, but that's a good story for another day, not this video. They've recently had a massive run. Now, can they get past this point? Now, over the past 5 years, if you look at their trading range, it has gotten past that long-term trading range, and that is good to see. Now, is this a good time to buy in? Yes, they've had a little bit of a drop recently from its all-time high. However, I shouldn't say all-time high, but their recent high, yes, they've had a little bit of a drop. It could be a good time to get in, but never go in all in at one time. You always want to buy small portions, because you never know where the next step is going to be. We could have an all-out war with Russia, and at that point, everything would drop. Its earnings look really strong. They've had 4 beats, 1 miss. That tends to happen once in a while with companies like this. But of course, when we're looking at oil going to all-time highs, you'll probably see a few more beats. Also, when it comes to the financials, their revenues are not topping out at all-time highs, but their earnings are getting very close, aren't they? Again, anytime a company goes through a recession, they cut fat, they make more money afterwards when it comes to earnings, generally speaking. And they have an amazing opportunity for dividend growth. They tend to raise their dividends substantially, a lot, and very often. NVDA is another business that looks extremely amazing right now. Yes, they pay very little in dividends, but there is what looks to be a potential big switch right now with the internet. There's a new thing called Web 3.0, which is basically Meta, Facebook style of me being able to meet with you, not being in your room or your house or your office or whatever it may be. So that, of course, needs a lot of infrastructure. We're getting more and more electric cars that need a lot more processors and graphics card style processing, because, of course, they need the power. There's going to be, of course, more of this new Web 3.0 stuff. There's going to be even more computers and cell phones and things like that being made. Guess what? Technology is here for good. It's not a fad anymore. And because of that, I think NVIDIA over the next many years is going to be really benefiting from all of this new technology that's being invented, especially electric cars. And then there's also companies like Tesla that are making a robot, so because of that, that takes even more processors. Average volume of 50 million shares of trading every single day. Very little dividend, just reinvest that. It's not worth taking the pennies. Over the past couple of years, it's basically skyrocketed. Will it hit that all-time high once again? Most likely. I kind of wish I bought it back when I bought Facebook stock at $15 a share. But that would be amazing, because now it's sitting at $221 a share. And yes, they do pay or raise their dividend, but it's not substantial raises. You're getting pennies. Now, Tesla, like I just basically mentioned, electric car company. They had amazing earnings recently. It's fantastic. It's a great company. Now, this company is just absolutely killing it. They literally just beat earnings once again, and Tesla is absolutely killing it right now. So, of course, they're having better luck getting processors for their cars, because they can take pretty much any processor they want, and they have the engineering power to be able to reprogram the cars to be able to work with those processors. That is a key thing that Ford, GM, and nobody else has, because guess what? While Ford and them are investing more into when it comes to their labor force to make cars, Tesla's actively trying to invest more into engineering. And if you are trying to basically get an edge on the competition, you bring out better cars. You get better engineers, and overall, you're going to be selling more. Tesla, in my opinion, is probably going to eat Ford's lunch and GM's lunch. And I don't say that happily. I like Ford. I have a Mustang. They're my company that I like. But Tesla is going to be probably eating their lunch unless these companies start actually investing in engineers, or at least guys who are actively smart enough to be able to look into the future. But at this point, Tesla is also looking at creating, of course, robo-taxis, semi-trucks, and even a robot that can probably take my job someday. Instead of me talking here, it will be a robot. So I'm joking. I'll always be making these videos. But overall, Tesla is really looking into the future. They've got solar power technology, battery technology, batteries that are built in-house. And that way they don't have to deal with the battery shortage that's probably going to happen over the next few years. They're currently apparently looking at investing into a lithium mine even. So there's a lot of things going on with this company that if you look out 10, 15 years, looks pretty fantastic. And then of course there is ARK Invest, the company, who says that within 5 years they're expecting Tesla's stock price to be $4,600 a share, currently sitting at just over $1,000 a share. So if that comes to fruition, you're looking at a 4x or even a 5x multiple on your invested money today in 5 years. So if all of this happens with Tesla, then you're looking at a company that is going to be probably the biggest company in the entire world in 10 to 15 years, in my opinion. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe. Tesla doesn't pay a dividend, and I'll see you guys again next time.